Okay, welcome back to our accounting for, I'm going to look at today in this video, I'm going to look at notes payable. Notes payable is a liability. And it's a promissory note to pay, right? It's a formal liability. It's different than accounts payable. It's not a trades payable. It's a formal obligation. There's two things to consider when we're dealing with notes payable. Number one, what is the due date? Things that can be tricky handling notes payable. What is the due date? And that becomes an issue of how do you calculate due dates based on a note. The second is really a question. Do we need to accrue interest? Accrued interest expense. And it's a question. And what I mean by that is this. Here's two periods. Time period 1, time period 2. Let's call this year 1 and year 2. Let's say we sign a note right there in October. Okay? If it's due sometime in the next year, then at this point in time we're going to have to accrue the interest expense. We're going to have to record an entry to accrue the interest expense and the liability for the portion of the note in year 1. This is only an issue when the note carries over from one reporting period into the next. So, notes. Notes payable. Number one, what is the due date? And do we need to accrue interest expense? So let's go through an example and see how this plays out here. Let's say that on October 10th, we sign a note for $5,000. It's at 15% interest, and it's let's make it a 90-day note. It's a 90-day note. There's our note. What did the entry look like when we signed this? We debited cash. Somebody gave us $5,000. We credited notes payable. There's the entry to record that. Now, let's calculate the due date. Let's use red to do it. I'd like to draw a picture. What is the due date? Well, let's just say here's October. Here's November. Here's December. Okay. And then here we have a rollover to the next year. When was the date? October 10th. So there's 10th is when we signed it. How many days are there in October? There's 31. How many days are there in November? 30. How many days are there in December? 31. So, how many days in October did we have this note? 21 plus 30 plus 31. So at this point in time, how many days have gone by? 31 and 30, 61, 82. Uh-oh, it's a 90-day note, so it rolls over into January of the next year. When is it due? Well, 82 from 90 tells us this thing is due on the 8th. So on the 8th of January, it is due. All that is a little calculation. Why do we need that calculation? Because of the second question. Do we need to accrue interest expense if it rolls over from one period to a second time period? And the answer is yes. Because we're not actually going to pay this note until January 8th of the next year. So generally accepted accounting principles, the matching principle, matching revenues with expenses, says that we need to record an entry to accrue the interest expense. So that'll be done on 12/31, December 31st, right? We need to record interest expense for 82 days of interest. How do we do that? $5,000 times 15% times what? 82 days over 360. We don't use 365, we use 360 for ease of calculation. And 5,000 times 15% times 82 over 360 equals that equals $170.83. So therefore, we need to record an entry. That's the interest expense for this period right here. So we need to record an entry that looks like this. Debit interest expense for $170.83. Credit interest payable for $170.83. Notice we've got the expense recorded and the payable that we're going to carry over to the next year. That's December 31st entry. Well, we're also going to have an entry now on January 8th when this thing is due on January 8th. And we have to record the interest expense for the last 8 days of the note. So it's 5,000 times 15% times 8 days over 360. What's that equal? That's equal to 1667. So on January 8th, let's put some dates here. This was on 10/10, October 10th when we took out the note. 10/10. This is on 12/31. Now on January 8th of the next year, we're going to record interest expense of how much? $16.67. We're going to record interest payable, debit interest payable, paying off that liability, $170.83. We actually pay cash to pay off the interest expense, which is $187.50. We're also going to pay off the note, right? Debit notes payable and credit cash for $5,000. We no longer have this liability. So there's two entries here. One is for the interest expense broken down into its 2-year pieces, year 1, year 2, and the other is to actually pay off the note right there. So had it not rolled over from year 1 to year 2, we would not have made this entry right here. This entry would have disappeared, would have been gone, right? That whole thing would have been gone. But because it rolled over from year 1 to year 2 in our calculation, we have to record, accrue the interest expense for year 1 that we then pay in year 2. So those are some of the nuances, excuse me, when it comes to accounting for notes. Number one, how do we calculate the due date? That's how I do it. I like to draw a picture and calculate it that way and see, does it roll over into the next reporting period? If it does, I get a flag in my mind that says, oh, then I have to accrue the interest expense. And so that's what we were doing down here, accruing the interest expense, which you actually paid when the note was due. So again, we'll have examples in class. We'll work through some exercises, but I just wanted to do a video on this because it can be a little tricky trying to figure out those two things. But those are the issues underlying notes payable. So we'll see you in the next video.